Professional quantitative operators view capital allocation as a dynamic transmission system. They shift gears automatically depending on the market environment's structural load. Retail amateurs, by contrast, operate with a completely rigid approach to risk. We call this retail blind spot the flatline matrix. When an amateur calculates their position size, they usually trade the exact fixed number of contracts or shares on every single execution, completely ignoring the structural state of the asset they are trading. This dual line chart illustrates the problem. A mathematically sound entry strategy deployed with 5 contracts in a high-velocity trend produces steady baseline growth. However, applying that exact same strategy and fixed size inside a sideways consolidation zone destroys capital. By treating a breakout and a tight consolidation as equal environments, the static sizing model absorbs massive friction damage. The account gets chopped to pieces because the payload remained fixed while the probability of follow-through collapsed. Financial markets constantly shift through different phases of volatility and liquidity. A static capital allocation completely ignores these real-time regime states and the structural friction inherent to a sideways market. Flattening your risk profile across space guarantees suboptimal performance. You fail to extract the true reward during maximum velocity breakouts, and you mathematically guarantee your own liquidation during low volatility compression traps. The solution is to abandon static numbers entirely. Optimal risk management requires treating your contract size as a fluid payload that automatically expands or contracts based on the structural state of the market chassis. This is the dynamic position sizing matrix. It relies on algorithmic scaling to ensure that the capital you deploy precisely matches the environmental probability of the setup. Instead of fixed lots, we define position size via strict payload scale parameters. These parameters range from an absolute 0.0 multiplier on the defensive end, scaling all the way up to a 2.5 multiplier for heavy conviction plays. These payload adjustments are never based on a trader's intuition or discretionary feeling. They are driven by a strict, hard-coded 4-state telemetry framework that reads the geometric structure of the chart. Dynamic position sizing directly connects your payload size to structural risk. When the market generates high kinetic potential, the matrix authorizes heavy capital. When that potential vanishes, the matrix cuts the capital feed entirely. Before any capital can be aggressively deployed, the system must establish a baseline filter to lock out toxic market environments. This dashboard displays the first structural condition, state 0, or the squeeze. The mechanical trigger for this state occurs when the volatility spread contracts tightly into a flat gray baseline rope, signaling an extreme drop in momentum. The operational rule for state 0 is absolute capital preservation. The payload is hard-coded to exactly 0.0. You stand completely aside and do not execute predictive entries inside this high-friction zone. Amateurs routinely attempt to guess the direction of a breakout during these tight consolidations. The quantitative rule dictates that you sit on your hands and let the kinetic energy store up inside the sealed cylinder, completely avoiding the accumulation of early friction damage. Once that energy releases, the matrix shifts to state 1, the standard base. Visually, the moving averages execute a clean chronological expansion, triggering a standard 1.0 multiplier payload. This is your routine trend continuation protocol. A standard 1.0 unit size perfectly matches the baseline mathematical probability of a normal, healthy trend environment. State 1 thrives precisely because state 0 was respected. By strictly isolating your account from degradation during the chop, you preserve your financial and mental kinetic energy to fully capitalize limit when this establishes itself. Routine trends build accounts slowly, but wealth generation requires shifting capital into overdrive when multiple disparate market variables align at a singular point in time. This is state 2, the confluence deck. The mechanical trigger fires when a correcting price wave drives down and collides simultaneously with multiple fixed quantitative levels and higher timeframe moving averages. This specific geometric alignment creates a massive structural floor. Price is trapped against an ironclad barrier, allowing you to define a highly precise, mathematically sound exit point just below the structural zone. Because your stop loss is rigidly locked just one single tick past that macro frame rail, your absolute risk in dollars remains completely fixed. Yet because the probability of a bounce is so high, the matrix authorizes your payload leverage to multiply to 2.5 times your standard unit size. Notice the system's fluid polarity. In a low probability state 0 squeeze, your posture is completely 0. In a state 2 confluence deck, your posture maximizes into heavy artillery. You drop the clutch and swing for the absolute bleachers. This maximum structural leverage is mathematically survivable and highly lucrative only because absolute capital preservation was strictly enforced during the low probability phases. The final environmental state accounts for the extreme margins of market geometry. Eventually, price action blasts out of a structured trend and pushes into an overextended, structure-free liquidity vacuum. We define this as state 3, overextension. The mathematical trigger for this regime requires price to exceed the 3 sigma standard deviation limit, pushing the engine into the red line. When operating in this vacuum, traders execute counter-trend mean reversion plays to catch the rapid snapback to the baseline chassis. However, fighting a primary macro trend requires extreme tactical precision. Because you are actively fighting the primary momentum of the market, the matrix rules dictate that you must aggressively downshift your contract load. Your payload drops to a 0.5 micro-unit size. You run light, nimble, and lock in profits instantly at the centerline. Fighting primary macro mechanics is mathematically viable only if friction is minimized by strictly running highly scaled-down tactical maneuvers. When you assemble these states, you possess a fully integrated, mathematically sound algorithmic engine. Real-time market data flows directly into the system, continuously scanning the geometry of the chart and dynamically triggering the correct payload multiplier without an ounce of human emotion or discretionary hesitation. The mechanical advantage is clear. You protect your capital during sideways chop, conserving maximum kinetic energy to deploy heavy payloads into perfectly aligned structural traps. Professional trading relies entirely on the strict mathematical discipline of matching payload size to verified probability. Let the geometry build the traps, scale units via strict telemetry rules, and protect your machine.